final 5-minute finance of the year. Luke, I'm getting a little choked up. I feel like 2020 has been quite the roller coaster, and somehow, some way, 5-minute finance was the little bit of good in society that we really needed.
Maybe, but let's cut the emotions, Matt. Let's give people the education information they're here for.
Nice to see you too, Luke.
Today, we're going to be discussing the differences between traditional retirement contributions versus Roth contributions, the advantages and disadvantages to both, and the long-term implications.
Thanks for teeing that up for me, Luke. I'll go ahead and start with the basics. Traditional 401k or IRA contributions. They're designed to reduce your taxable income in the year that the contribution was made. For example, if Carson is making $150,000 per year and contributes $10,000 to his 401k, he is reducing his taxable income by $10,000. If Carson's effective tax rate was 25%, he would be saving $2,500 in taxes not paid by contributing $10,000 to his 401k. As long as Carson follows the IRS rules surrounding 401k plans, that money grows tax deferred, and when Carson goes to withdraw the funds in retirement, the full withdrawal is subject to ordinary income tax in the year that the withdrawal is made.
Yes. Now, on the other hand, Lamar is at the same job as Carson and is also making $150,000 per year. Lamar, though, is contributing $10,000 to his Roth 401k. Lamar is not receiving any tax deductions for those contributions. He is paying tax on the $10,000 before his contribution into the Roth 401k. Assuming Lamar is also at an effective tax rate of 25%, he has a total out-of-pocket cost of $12,500 for that savings contribution of the $10,000 that he contributed to the Roth 401k, plus the $2,500 of tax he had to pay on the income. Here's the main difference. As long as Lamar follows the IRS rules surrounding Roth 401ks, his funds will grow tax-free, and when Lamar withdraws the funds in retirement, both his Roth contributions and the growth on those funds will be withdrawn tax-free.
It's unknown to us where U.S. income tax rates will be in the future. We know where tax rates are today, so Luke, is it fair for me to say that there is a little more uncertainty with traditional money than Roth money, seeing that if we know where tax rates are today, Roth means we're paying tax on what we know, and then we don't need to worry where taxes are in the future for that money.
Yes, that's fair to say. It's certainty or uncertainty as well as possibly control. But what is not fair to say is that one type is always better than another. For example, for a young professional who has a long time horizon until retirement and is anticipating making less now than they will be in the future, Roth contributions could make more sense. Pay income now while at a low bracket and allow for many years of compounding tax-free growth. And conversely, for an executive level pre-retiree finding themselves in the highest income tax bracket, it could make sense to utilize traditional contributions and help reduce taxable income today.
I think it is safe to say, however, that this isn't something that should be chosen all willy-nilly. Tax decisions should absolutely include discussions and insight from your specific tax advisor, as each person's situation is unique.
Yeah, Matt, there's another big piece to this discussion that involves required minimum distributions, or RMDs. Assuming at retirement, the traditional 401k is moved to a traditional IRA, and the Roth 401k is moved to a Roth IRA, only the traditional IRA will be subject to RMDs. Under current tax law, beginning at age 72, the IRS mandates that you withdraw a certain percentage out of your pre-tax retirement accounts each year so that you have to realize or claim that forced distribution amount as ordinary income and therefore pay tax on it. These RMD withdrawals are added to the other ordinary income, such as pensions and or Social Security, which not only increases the total amount of taxes paid that year, but could also cause an increase in the effective tax rate from a jump into a higher tax bracket. The same is not true Not true for Roth IRAs because you've already paid tax on that money. RMDs do not apply to funds inside Roth IRAs.
But Luke, what if Carson, from our earlier example, doesn't want and doesn't need to withdraw from his traditional IRA at or after age 72? What if his fixed income sources are satisfying his full lifestyle?
Good question, Matt. And unfortunately, Carson still has to take his RMDs. If he doesn't, he can be subject to steep penalties imposed by the IRS. And that scenario of being forced to take unneeded and unwanted withdrawals is one we often see with clients who have been good retirement savers. Now, Lamar, also from the earlier example, has the freedom and flexibility to withdraw from his Roth IRA as he chooses, as long as he's followed the rules, of course. So this is a topic that one could be paying attention to when considering their own retirement planning strategies.
What a great way to wrap up 5-Minute Finance in 2020. Now, there is a big announcement coming from the 5-Minute Finance team in 2021, and we know you'll be excited. Be sure to tune in on the first Wednesday in January as we unveil the big news. Have a safe, healthy, and prosperous holiday season, and we'll see you next year.